Hi, friends. Welcome once again to this segment. So, we'll be looking at the third component of business ethics. At this point, we'll be focusing more on corporate governance. So, corporate governance we, cannot be left outside the discussions on ethics. Now, ethics plays a very key role. It defines the corporate culture. It helps us to define the tone at the top because from there it permeates throughout the whole organization. It also dictates the kind of CSR, corporate social responsibilities that organization could take. So they are interrelated, ethics, CSR, and corporate governance. In fact, the corporate governance drives these two because we always see the corporate governance being managed by the tone at the top, and they will dictate how much resources should we invest in the CSR activities, how much support do we give to organizations, the employees within the organization, cooperate with regulators, with agencies to ensure that we comply with the ethical code of conduct that govern our organization. All right, so let's look at ethics as I share the slide. Okay, so let's look at ethics from the dimension or from the direction of the corporate governance practice. Okay, so like I said, what is corporate governance? Simply talks of how we direct, how we control, how we manage the organization. Okay. Over the past, the reason why corporate governance has gained prominence because the public lost interest in the accounting profession. Consider those prominent companies, WorldCom, Enron, Barron's Bank. Okay. And these were situations where these organizations had auditors, accountants, chartered accountants, professional accountants in post positions in good standing who went conducted all the audits and investigations and evaluations and yet found nothing. Sometimes it is perceived that they even connive with the management to ensure they conceal some of this stuff. Okay, so because of that, these major public scandals, there was the need for organizations, for countries, for regimes to institute some robust governance system that will help those at the top notch, the senior executives to run these companies or these organizations in the way which is deemed in the best interest of all stakeholders and of the society. Okay, so we'll be looking at it typically from the UK dimension. Okay, from the UK dimension. Now, take note of this. Normally, the corporate governance affects those listed companies. In the UK, we have two different types of limited liability companies. So we have the ones which have the ending LTD. So like ABC Limited. It is a company, it's a limited liability company, but normally with the LTD at the end, with the limited at the end, it means it's not listed on the stock market. But when you see PLC, ABC PLC, it means it is listed on the company. It is a publicly listed company. Okay, so normally the corporate governance system applies to the PLCs, not the LTDs. Some LTDs also put in place robust systems of corporate governance, but normally we're looking at this discussion from the dimension of the listed, the quoted companies. What are the importance of running a corporate governance system effectively in the organization? What is perceived is that it reduces risk. It is anticipated that any organization that puts in place robust corporate governance system actually helps the organization to identify risk ahead of time, prevent them from occurring, and even when risk has occurred, it helps them to put in place strong detective mechanism that would unearth these weaknesses and helps in fixing them in time. So risk reduction is very important. It helps a lot in terms of undertaking or running an effective corporate governance system. Again, it is also deemed that a corporate governance system helps in improving performance at the workplace in terms of effectiveness. How do we meet our objectives? And then efficiency. And even sometimes economy. How do we use limited resources to achieve our objectives within a stated time at a reduced cost? Okay. And also it helps to gain or co-opt the support of regulators, of supervisory authorities. Okay. So these are the main benefits which have been linked to an effective corporate governance system. But of course, there are more we can also think of. It reduces risk not just for the organization as a whole, it also reduces risk for investors and other stakeholders. It also gives you some form of transparency for the organization, okay, where there's some timely communication of information across board. It is also seen corporate governance helps in improved performance and leadership by the board because at the end of the day, it is more or less linked to the leadership. Again, one good importance of corporate governance is that it allows for greater fairness and openness of directors. One person cannot hold more than one position and run the company as if it is his personal life or try to dominate having so much authority vested in him. Okay. Again, like we know, we cannot never discuss corporate governance without linking it to the lack of confidence the public had in the organization. So if you put in a strong corporate governance system, your overall intention is to ensure that you gain a greater public confidence in your company. So it's one importance of corporate governance. We cannot explain corporate governance without looking at that particular importance. Greater public confidence in your organizational operations. So, like I cited some of these things, how did it come about? This organization, Barron's Bank, Polypec, Maxwell Communications, Robert Maxwell, okay, Enron, WorldCom, RBS, they showed weaknesses in corporate governance. If you read any of the stories, or if you even um, watch the videos on YouTube, you can get, for example, Barron's Bank, where this guy, after being released from prison, comes out and then lists the number of weaknesses that made him run the whole company down. Okay, that company could have been a star in our times today. Then a number of weaknesses which we saw, which underlying these scandals, public scandals, were domination by one single person, having so much authority, doing things on his own without any second person looking at it. Then board not getting involved, lack of board involvement, lack of adequate controls. Sometimes even when the controls are there, they circumvent the controls because tone at the top allows that. Okay, lack of supervision, like I said, you do it all alone. No one checks or reviews what you've done. Nobody scrutinizes what you do. There are no contact with shareholders. We work on our own, only to meet the shareholders at an AGM and tell them what, what they want to hear. Okay. And then it was also more of looking at short-term profits, making money quick. Okay. Be careful when you want to make money quick. Sometimes you end up, cheap things are expensive. You end up losing everything. Okay, cheap things can be very expensive. And also, one other aspect was that they misled the account, they forged the account, they cooked the account, and misrepresented the information. All the disclosures, the reporting, the narratives were poor, were wrong. Okay, just to mislead. Now, how did corporate governance originate within the UK? Okay, within the UK. So when all of these scandals started, the UK decided to say let's put in place some systems. Okay, so in 1992 they set up the Cadbury Committee. So they proposed some best practices on how to run the organization. In 1995, they then instituted the Greenbury Committee. These guys came out with the fact that there should be directors' remuneration clearly stated, clearly disclosed, and reported in the books. Okay, so that people will know what the directors are earning. In 1996, we had the Campbell Committee, and they also consolidated these best practices as Cadbury Committee brought out. In 1998, just 2 years after that, this same committee, in terms of their consolidation, decided that directors' remuneration should form a core part of the principles of good corporate governance and a code of best practice. So they all sort of come in together to consolidate the same report. So from 92, 95, 98, they came about with this. And one thing which was prominent was the director's remuneration. Okay, they came about. So in 98 we had a combined code, but now we no longer call it the combined code. It used to be a combined code from three committees. So they then moved on. In 1999, they had the 10 Bull Committee, and here they came out with proposals on internal controls and risk management. Okay, again, they worked almost line in line with a couple of committees which were set up, or these other committees also corroborated the information from Turnbull. So we have Higgs report of 2003, where they suggested the need for non-executive directors. In the same year, 2003, Smith and his guys also came about with this report where they said, let us set up audit committees to help run these organizations. And next, the non-executive directors were all to be on the audit committees. So in 2003, we had a combined code again, and it covered these reports, including the directors committee, the directors remuneration report at the top. So the UK code came into force 2010 actually, but it was revised. It had been revised since then, from 2010, revised in 2012, 2014, 2016. Almost every 2 years it was revised. I've not seen 2020 revised code, but as it stands, it was 2018 revised, the most recent one, which is still in place. Okay, now there's one principle we should always look out for, one particular discussion we cannot do away with: agency theory. Remember, the company belongs to principals, the shareholders, the investors who have toiled and given you some money to run the business. So we are seeing the company, the directors, those who are running the company, the management, those charged with governance of the company, to be just agents. So they are parties who are employed by the shareholders so that they can act on behalf of third parties, not just the shareholders, but to the greater stakeholder community. So these agents must ensure that they carry out their activities in line with what the principal requires. So the principal holds them responsible for whatever actions that they undertake. That's why you see the management being rewarded with big or fat bonuses at the end of the day when they meet performance targets. So agency theory is looking at the relationship between the agent, the management, their relationship with shareholders, their relationship with other stakeholders, with governments, with the community at large. Okay, where did they go wrong? They should fix it. Okay, when problems arise, then agents must act on their own and not for the principal's benefit. So we expect that you work for our benefit, yes, make the profit for us. But when there are problems, we expect you to fix it before you bring it to us. Because we cannot run the business on day-to-day basis, that's why we've given it to you as management to run it. So you don't expect to be getting challenges in terms of operations and you call the investor who has no knowledge about business running. He's only interested in making dividends at the end of the day. Okay. So in any company, there's always a divorce of ownership. We always say the company is a legal separate entity. So there's always a separation between ownership from control. Shareholders are not involved in the day-to-day. You, the management, must run the operations on a daily basis. So the goal of shareholders should totally be different from that of management. But at the end of the day, they all converge that the resources which have been given out by the shareholders must be put to good use, maximizing the shareholder wealth. That's where they are all looking at, especially for profit-making entities. Okay. Now, corporate governance, why is it not working? We are doing everything by organizations to ensure it works, but sometimes it's not working. And those are the major problems. We'll revisit this again at the end of the slide. Why is it not going? What are the problems? Okay, we'll re-highlight them. So it is all about domination of the board by a single individual. Some of the symptoms why poor corporate governance systems are still running. When you see one person who is a board chairman having so much control, sometimes he can dictate to the CEOs, to the CFO, then you know that the system wouldn't work. Okay. But if you allow everybody to play his or her part, then you will be confident that the corporate governance system of the organization would work well. Again, when there are no involvement by the board, so meetings are being held, board is not taking part, okay, meetings are also not held as required. Sometimes we just take decisions without looking at what is causing the problem. We need to research. If it happens that board is not fully involved, they meet once a year for the annual general meeting. They meet twice a year. Normally, board meetings is required at a minimum in every quarter so that they will review the operations. Again, when there are no controls, or where there are controls but the controls are not functioning, or where there are controls but the controls are functioning but they are being overridden by the top, senior management at the top, then all that we are doing is at naught. So three things: inherent controls, they are not there. No controls at all, then it will not work. There are controls, but the controls are not working. They are just on paper. There are controls, they are working, but only a few people are being directed or controlled by the controls. But those at the top, they override it. They run over it. Okay. Again, when there are no audits and evaluations, third party evaluations, then you know the corporate governance system wouldn't work. When we don't contact shareholders regularly to give them feedback, corporate governance system wouldn't work. Okay. Emphasis on short-term profitability is dangerous. Look beyond the short term. Strategically plan ahead, the horizon. Look at the end. Can we survive in the next 20 years? Okay, then in that case, you don't even care when you are making losses now or you are breaking even, because the picture you are looking at is the longer term directive. Okay, again, when there are some misleading financial statement and information, wrong financials, cooking the books, using inappropriate accounting policies just because you want to bloat the profit, it's not right. Okay, it makes the corporate governance system not to work. Corporate governance systems are in two ways. So in the UK, we use the comply or explain. UK system is more of a principles-based approach. The UK system is more of a principle-based approach. Can you comply with these regulations? Yes. If you cannot comply, explain why you think you cannot comply. We need 7 members on the audit committee. No, we don't. We cannot get 7 members. We can get 5. Why? Because we are not able to attract, or we are not getting qualified people. People are not ready. We've done all we could, but we can't. So you comply or you explain. That's a principles-based approach with the UK governance system, UK corporate governance code hinges on. But then we have the rules-based approach, which is the USA system. So again, driven by this same scandal. So they have the Sarbanes-Oxley Act, SOX, of 2002. For them, it's not about comply or explain. Theirs is typically enforcement and documentation. So to them, they will enforce it. In the UK system, the code has no force in law. Okay, so it is only enforced on listed companies through the stock exchange. That's the UK. Because you're on the stock market, you are listed in the stock market. We can enforce it from there, but not legally. Okay, so listed companies, they are expected to comply. It's just a trademark. That's all. They have to state if they have complied. If they cannot, why? So there's some flexibility there. Non-compliance is sometimes acceptable, and so they state it. Okay, but the US system, no, you have to enforce it. Okay, so again, for them, it is more of detailed, and they have a number of points on the SOX. You must get an audit committee, is compulsory. Okay, you must also have external auditors, yes, but these external auditors cannot, in addition to auditing you, offer other advisory services. That's the US system. If there's a senior partner on the audit, every 5 years you must change him, you must rotate him. That's the US system. That's the enforcement and documentation. Again, they also prohibit directors from holding shares in some sensitive times. If the director knows that if there's, let's say, going to sell this organization to a prominent organization, or there's a takeover and then the director decides to hold shares, they can restrain them. And they also require, like the name sounds, documentation, detailed documentation on their financials. If there's any off-balance sheet financing, you need to detail it out. Annual reports must not just be the numbers. They have some detailed notes accompanying them. They must state the controls in place. So typically, try and take a published or an audited financial statement of a US company like Apple and compare it to a UK organization and see the difference, the details. Okay. And again, for them, they always require the CEO or the CFO to sign off on the financial statement. So that's the UK system, the SOX controls. Okay, theirs is more rules based, and the UK, our system is more of principles based. Okay, let's move on quickly. So the code looks at a number of areas. It's split into 5 areas: the board leadership, the company purpose, responsibilities which has been segregated clearly, the structure, succession and evaluation, audit and risk control, and remuneration. Okay, let's take them one after the other. Now, the board. Key facts about the corporate UK corporate governance code. The board. The board is expected to have leadership. So the board should not just be one-sided. It should be a blend, a multidisciplinary group of guys who can better understand how to run the business. They all have different and varied skills. There should always be a clear-cut role. The chairman of the board should not be the CEO, or else we risk giving so much power to one person. Again, they should also disclose the number of meetings and attendees to improve involvement. Document them. How many are on the board? How many attended? Okay. Usually, they look at a quorum of 1/3, but if we get more than that, it's better. Now, the non-executive directors, these are guys who are not involved in the day-to-day running of the business. They should be totally independent. They don't have to hold shares in the company. There are a number of points that you need to consider to ensure that the nets are independent. Now, the nets, what they do typically is that, like I said, they should be independent. Okay, to ensure independence, they should not have been employed in the organization over the last 5 years. And at least we should have a 50-50 board membership in terms of nets and then the heads. Heads are the executive directors. What the nets normally do is to direct strategy. They have the strategic role, chart the strategy of the organization, they challenge the strategy, they offer constructive advice. They also scrutinize the roles of the executive directors, and they also look at risk roles, people role, hiring the directors, appointing directors, setting their remuneration. Okay, so those are normally the roles that you will normally find in terms of the non-executive directors instead of the non-executive directors. So there are a number of things we could look at. So one more thing, especially on their independence, I think we can also look at it. One is that to ensure they are independent, they should have as many nets as possible. Okay, they should always oversee the shareholders' interest. So these guys are not running, so they are more or less like outside guys. They don't have to have shares in the company, so they are always looking at protecting the interests promoting the interest of the shareholders. That's it. Okay, and their independence will help ensure that there's effectiveness and objectivity in the organization. Then we have the nominations committee. So these guys, the nomination committee, they are normally the ones who help to make appointments of the directors, of the big guys at the top. And again, half of them should be made up of nets, independent nets, so that they don't end up scratch my back, I scratch your back. But it happens, there are some risk with this case, because remember, the non-executive directors are paid some fees. So if they set a very good remuneration or bring in their own colleagues, their colleagues will also help them get some better fees on the as net fees. Okay. Again, remuneration committee, no director should be involved in setting the level of their own remuneration. It should be made up of nets totally. The remuneration committee is totally nets, okay, because they are not running the day-to-day activities. And the remuneration should be enough, should be sufficient enough to attract high quality directors. Else you end up not getting a great caliber or skill set who will come in to run the organization. Then the audit committee, sometimes you see them as risk management committees, and they should be made up purely of nets. Okay, they will look at how effective internal controls are. They advise on risk. Okay, they look at internal control systems. Are they working well? If there's an internal auditor, they report directly to the audit committees. Okay, if there's any implementation of audit recommendations from external auditors, the audit committee looks into it and ensure that these are being done to the letter. They are the first point of contact, we have been told, for auditors. Key, very important. Now, limitations of corporate governance, like I said, it has always been at the board level, stuck at the board level. So we are all looking at the board level, who are just looking into specific areas like audits, risk and remuneration. So you don't see it trickling down to the mid-level or to the ground, to the grassroots guys. Again, corporate governance code seems to be placing a lot of emphasis on the tone at the top. Well, this could be the right thing to do because at the end of the day, who will be held accountable for the running of the business? Those are the top. Normally not the middle level or the operational level. So those are the top. So more concentrated there. Now, the very regular updates of the corporate governance will suggest it is a living, adaptable document. Have you seen how it has evolved over time? From 2010 to 2018, almost every 2 years we revise it because things keep changing. Today there's COVID, so I'm sure the next time we'll see the corporate governance code will be revised to include automation, IT systems, AIs, technology to ensure that any or more of the committees would have some roles over looking at technology, health and safety, human lives, and so on and so forth. Okay, so I'll end it here. There is more that you can look at or you can read on corporate governance. Some of them I've touched them because you don't find them on the slide, but I think you can look at it. Okay, so look at it very carefully. Read around them, board leadership, how effective, how they account. Okay, look at the audit committees in details. What are the general principles? What are their rules? The Financial Times Stock Exchange, look at them. What are their requirements? How many do they need? Okay, the nomination committees, what is their key role? What are their typical roles and responsibilities? Okay, what is the requirement in terms of the nominations committee? Okay, and then at least it gives you some very good understanding of what the entire corporate governance system means. Okay. All right. So there are other theories also. We look at only the agency theory. But remember, there could be a stakeholder theory. There could be the stewardship theory. Okay. And then we have the political theory and transaction cost theory and resource dependency theory. You may not need it for this module in terms of assessment, but it helps you to understand it so that once you find yourself in the workplace, you should be able to apply these and relate to these and speak them out as if you are the owner of it. All right, friends, thanks so much. I'll see you in the next session of ethics. That one is just a summary of everything. All right, see you soon. Thank you. Bye.